is that what I learned at Renaissance is that when we're ready to trade, information doesn't matter. Like, you think we'd have, hundreds of people pouring over news feeds, watching news, trying to figure out what happened in the world. The truth is that while some people do trade that way and they can make fundamental bets on stocks that they want to hold for a long time, we were trading in and out of stocks pretty quickly. Not quite high frequency trading, but we were trading out, holding, like we say, from a day to a week to a month. But usually on the shorter side. And when generally what we looked at was not news. We just looked at price movements, because we assumed that any news we could see as people, someone else had already seen that news. They'd already traded off of it. And whatever I needed to learn from that news was already encoded in some way in the prices in the stock market. So all our models just looked at price and volume and trading volume and how much trading was happening on different parts of the spread and how deep the book was of orders that were waiting. We looked at the actual people betting on the market, and we assumed that anything that could be known about stocks, especially because we're trading 4 or 5 or 10,000 different stocks at a time, that we couldn't possibly figure out what was going on in the world from the news. But we knew that there were people who were experts on every single stock who were reading the news, and they were trading off of it. And so if we just looked at the stock prices, we could glean what we needed to know about stocks. So it's important for you to understand, if you guys are thinking about doing trading on your accounts that you guys are managing, when you see news happen, you have to assume that everyone bigger than you already knows that. So you can't assume, oh, there's just been news about Disney, I'm going to go trade because Disney's going to go up because of that news. No. Everyone who trades Disney already heard that news, minutes to hours before you did. They've already traded off of it. And if they're going to buy Disney stock based on that, the stock price has already moved up to where that news reflects the price should be based on that news. So you want to be thinking, not so much reacting to individual news or immediate news, but thinking long-term about what it means. A lot of times people overbuy things and stock prices go up more than they should based on news. And if you could think, wow, they've overreacted to this news, and tomorrow they're going to look at this and say, wow, this is really dumb. We shouldn't have bought this stock. We shouldn't have bought Disney. Then you can use that intuition to say, hey, I'm going to bet against Disney because it went up too much. And that's kind of the kind of thing we would look for as people over betting, and we call them reversionary signals. If we saw a stock going up too much, we would sell it, and especially looking at it relative to its industry. But basically, we learned that information news is not what you think it is. Eventually, we figured out that there are ways in which news can be useful. Like I said, if you see some big news happen and then you see a stock go up a lot, the combination of that news and the stock going up might mean it's going to go down. So positive news about a stock may actually be a sign a stock's going to fall. And so that's where it's kind of like, that's why using computers and math and statistical models to bet in the stock markets is sometimes better, because human beings think a certain way, and all the traders out there are human beings. Well, these days, not as much, but there are a lot of human beings behind the trading going on, and you want to be thinking ahead of them. And you can't get ahead of them with information because they're going to beat you to the information, but you can get ahead of them by thinking about their psychology and thinking how you can game their thinking and then kind of reverse engineer what they're doing. So that's one thing that we learned about the markets that really were key to me understanding how I should view the markets. And just, I usually mention this at the end, but I don't own any publicly traded stocks. I probably have less than 1% of my overall net worth invested in publicly traded stocks. And the reason I do that, and I'm not recommending that, God forbid, you should learn about the markets, and most people in the world do invest in the stock market, and it's a good thing for retirement and for long-term planning to be invested in stock markets. But I understand from my experience at Renaissance, and also by seeing other companies like Renaissance blow up, that the values that companies have in the stock market, sometimes they're based on the value of a company, but a lot of times they're based on some market player choosing to buy a lot of a company or short a lot of a company for reasons that have nothing to do with that company. A lot of times companies will use kind of what we call boring stocks. So let's say you have like let's call Microsoft, for instance, a boring technology company or IBM. They're old companies. They're not so volatile. They're not going to double in, well, they've gone up a lot lately, but they're not typically going to double in price. They have low volatility, but they're representative of the technology industry. So if the technology industry is going to go up 20%, Microsoft's probably going to go up 20%. IBM's probably going to go up 20%. And let's say you have some really cool, volatile new technology company that you want to buy. I mean, Tesla's a bad example, but it's not really in the same industry. But let's say you have a Tesla-like company that's new to the industry, that's really a high flyer, and you want to buy it. But you don't want to take the risk that technology stocks are going to tank, because you just think that the company you're betting on is going to go up a lot more than everybody else, not necessarily go up, if technology goes down. So what you might do is you might buy that stock and short IBM or short Microsoft. And that way you're covering your risk that technology stocks, the whole industry is going to go down, but you're still going to bet on your high flying stock that it's going to go up. And so a lot of times when you look at the values of stocks, sometimes they don't reflect the value of the company. They might reflect the fact that there's some really big hedge funds out there that are going long a bunch of volatile stocks in the industry, and they got to short somebody. So they're going to deflate the value of these boring stocks in a way which is going to affect, if you own those stocks and they go down in value, you're still going to lose money if you have to sell the stock, even if, there's nothing fundamentally wrong with the company. And, we learned this because there was this period of time in 2008 where all of a sudden, almost literally, every quantitative hedge fund in the world started losing money. And not just like a little bit of money. Like Renaissance lost 20 times more than it ever lost in its history. And it was losing money every day. And it was such a bad run that if it went on for another week, we would have gone out of business. And a bunch of funds did go out of business. And long story short, what ended up happening was there was some big hedge fund that was like Renaissance in some ways that went out of business, and they sold off their whole portfolio. And they did it in a really clumsy way that caused all of these boring companies that everyone was using to short, hedge their exposure, to go up in value because this fund was buying them all back. And so there was this huge mispricing of all these different instruments that happened for a few weeks, or maybe a week for 2 weeks, that affected every quantitative hedge fund in the world that used similar models. And when it stopped, we made all of our money back, most of our money back. But there was a period of time where we were losing like over $1 billion a day. We were losing over $1 billion a day. I mean, think about that. And it was all because of this phenomenon that hedge funds push prices of instruments around in ways which don't reflect their fundamentals. And if a big fund decides to dump all its stock, then it's going to have the market's going to have a problem. So that's the main reason why I don't feel comfortable investing in stocks, because I'm not looking. If I was looking to be a long-term investor, it doesn't really matter when you get in. You hold stocks for 20 years, and then they're going to move where they're going to move. But I don't like to be an active trader in stocks because I feel like their values are manipulated.